Hey guys, it's Willie. Today I want to take a look at US Steel stock. I've pulled up the 1-year chart, and as you can see, you see a lot of volatility going on in the chart. You see a 42% gain over the past 12 months. Currently it's trading at about $24. This is a stock that I own personally in my portfolio. And I think a lot of people are going to be surprised here in a minute when I switch over to the spreadsheet that I own it because of the financials being terrible. Essentially, your cash flows look really, really bad. We'll get to that in a minute. But I just want to make this video to kind of show that even though the fundamentals, such as revenue and earnings and things like that, can look bad, there can be other reasons that you own a stock. It doesn't have to be based on one particular method. So I'm going to use this video sort of as a teaching moment rather than a strict sort of going through the valuation, going through the motions sort of video. Use this as a teaching moment and show you a different way of looking at a company. So with that said, let's switch over to the spreadsheet and I'll explain why I own a company with terrible fundamentals. Alright, so I'm in the spreadsheet and I want to really quickly go through the stuff that we normally do. Revenue, down, not good. Net income, lots of negatives, down, not good. Free cash flow, lots of negatives, not good. Shares, up, not good. Earnings per share, negatives, not good. Free cash flow per share, negatives, not good. Okay, so any other time that I would be looking at a company like this, if I'm sitting down and doing my own research, like we all should, I would not be interested in this company whatsoever. I become immediately uninterested in a company when something like the earnings are negative. The reason to invest in a business is to make money. So why would I invest in a business that doesn't make money itself? I don't expect to make money off of a business that doesn't make money. So immediately, I'm out if I'm doing this from the usual free cash flow earnings sort of mindset that I usually use for investing. So then the question comes up, well, if you don't like this stock using the method that you like, why then do you own the stock in your portfolio? With that question said, it doesn't sound like I'm making a whole lot of sense. Let me try to clarify that. So this stock was identified to me using a mathematical formula. So there's a book called The Acquirer's Multiple by Tobias Carlyle. I'll put that sort of stuff in the description below so you guys will have it, and you can look it up and see what you think about it. But I read the book. It's a lot like the Little Book That Beats the Market by Joel Greenblatt, where he talks about the magic formula. But Tobias Carlyle came up with this idea more back to a Ben Graham approach to investing rather than a Warren Buffett approach. So Warren Buffett says, you want to buy wonderful companies at fair prices. And that's what Joel Greenblatt did in his book, was come up with a mathematical formula to try to replicate that. And it worked, and it beats the market, and that's great. Tobias Carlyle said, well, wait a minute. Warren Buffett learned from Ben Graham, right? So Ben Graham would just say, buy cheap stocks. So Tobias Carlyle came up with the acquirer's multiple. Back tested it. It comes up really good. It comes up really great. Beats the market. Does really good. So I like to focus on the acquirer's multiple and buy the cheap companies that the acquirer's multiple, as a mathematical formula, identifies. I buy a portfolio of 30 of these stocks. That way it's diversified enough, and as a whole, portfolio as a whole, it's not risky. And it should beat the market over the long term because you're buying a collection of companies that are cheap. So let's quickly look at why I think the acquirer's multiple identify this company without getting into all of the intricacies and mathematical calculations that the acquirer's multiple does. So if we take the debt and we subtract the cash, we get $6 billion. Alright, so you have to pay off $6 billion in debt. Okay, let's say you're buying this entire company. The market cap right now is about $6 billion. The net debt is also about $6 billion. So you're talking about $12 billion to buy the company outright. Okay, let's say you decide to go through with it. Well, you've got $12 billion in assets right now. So essentially, after you buy the company, you put in all of your $12 billion in cash, you get back $12 billion in assets. So you're breaking even right there. And you're getting whatever income comes in from the business in terms of net income and free cash flow. Granted, the free cash flows are not that good, but you're getting these for free, and over the long term, the free cash flows have been positive. So, plus it's a highly cyclical commodities business. But, you're essentially getting the business for free because of how the assets, the cash, and the debt play on each other to basically equal zero to give you the business for free. So this is why, even though, like when you look at our metrics, the PEs and price to free cash flows are terrible because the earnings and free cash flows are negative. Net debt to free cash flow, again, free cash flow is negative. Earnings growth is negative. Revenue growth is negative. Earnings growth went from a negative number to a more negative number, which is technically a positive growth rate, but we don't want to see it going in that direction. Free cash flow growth, you're getting an error there. It's not really good. Shares outstanding up. Return on invested capital, it's okay. But I just wanted to make this video to show that even though the metrics, the analysis that we would normally do based on these numbers over here, and we would forecast forward, don't look great, you can also identify companies using this sort of other half of the spreadsheet, if you will, with the balance sheet sort of numbers to identify companies like this. It takes more work, I will admit, to identify companies like these. You've got to do more math and thinking in your head. But I highly recommend everybody look into the Acquirer's Multiple. The book was really short and it was really good. I was impressed with Tobias Carlisle. He's very knowledgeable, and he's very good at putting these sort of complicated concepts into a simple, easy to understand form. So yeah, I'll put that all into the description. I just wanted to show a different way of looking at a company today, and why I own the company in particular. But with that said, as always, do your own due diligence, do your own research. I'm not a financial professional. Don't listen to some guy on YouTube. Okay? That's just that. Like, comment, subscribe, all that YouTube stuff that you do. And I will stop here, and I will catch you guys in the next video.